the message from the Fed last week was taken with a lot of credibility in the markets. And it was not a reaction you would otherwise expect with major volatility in stocks and significantly higher interest rates and lots of volatility there. It was really about the Fed is starting to really get ahead of this inflation problem and may indeed hike with more than just 25 basis points in the foreseeable future. So it's what we call bringing forward a rate hike, so front loading. I think that brings indeed the opportunity that inflation at some point starts to moderate. And for the Fed, it has an advantage, right? It is the central bank of the reserve currency. So if the dollar strengthens more, as a compounding effect on global commodity prices to moderating inflation in the future. So I think that brings along the opportunities in the small mid-cap growth stocks, emerging markets. I think those are the opportunities to go with.
On the emerging market side, Ben, if we start to see inflation moderate a little bit, a lot of these input costs, I mean, you look at things like the price of fertilizer, it's going to just surge food costs. Poorer nations are going to be less likely to be able to afford what they need. There's a lot of other implications outside of markets of things like that. But if inflation does hopefully moderate a bit, is that part of the reason why you think specific emerging markets outside, obviously, the U.S. will benefit? What is the connection?
Yeah, I think you want to look at it from two ways. So one is the theme that was sort of happening last year, where you had central banks in particularly Latin America getting already much faster ahead of inflation than here in the United States. So that's Brazil and Chile as an example. Those markets are up year to date, and interest rates have risen there quite a bit. Their inflation is moderating. But now, as you mentioned, like you have the shock from Ukraine on global commodities. But you also have now pledges by China trying to stabilize its market. And believe it or not, that Russia did pay its coupon on the dollar bonds, which means the hard default is off the table. So I think that's another sort of short-term momentum behind the emerging markets trade. And lastly, if we do get to some sort of ceasefire, which seems to be slowly happening, part of that will be reflected into the commodities market, taking out all this war premium, as we call it. So I think that all benefits the emerging markets, not all out emerging markets, but I look at that broader emerging market index, or the ETF, that's really like now to the one that's ex-Russia, ex-China. I think that's where your opportunity is.
And before we let you go, Ben, also a name like a CVS. I did a hell of a transition there from emerging markets to U.S. healthcare stocks, but that's the kind of thing that you're thinking about.
Yeah, if you think about we don't really want to talk anymore about the pandemic, but we actually do have to an extent, right? We have another sort of, I guess, surge on the way. The stay-at-home trade is another one that's not talked about much, but has lagged a lot since last year. I think that's coming a little bit back here. It's two reasons too. Right? We have high inflation, so people may not do as much outside it for a period of time. Plus, the COVID issue may come back a bit, so that trade may revive a bit. CVS is really undervalued opportunity. That's one example. I'm not an analyst on it, but it's one example. Yeah, that's the stay-at-home trade.